How's it, guys, and welcome back to another video. Today's video will be about order blocks, specifically the validity of an order block. We are going to learn how to identify an order block, what are the requirements for a valid order block, how to trade a valid order block, and how to manage risk when trading order blocks. Like with everything else, we first have to define what an order block is. Well, you can define an order block as a candle or a series of candles that are or is responsible for a change in a state of market delivery. This means that whenever we see an order block, we can interpret it as a possible sign that a state of market delivery, whether from bullish to bearish or from bearish to bullish, will occur, right? So let's discuss the validity of an order block that you're going to use. But first, you have to have a higher time frame PD array in place, because you have to know the bias of the market. You have to know whether you'll be selling or buying, because if an order block formation occurs in the middle of the market, it has no value because it has no bias attached to it, so it becomes low probability. So what you have, if you have a higher time frame PD array, the next thing that you have to have is you have to have a liquidity sweep. If you can look at this example, we have this high and the market made a low and the market then made a high. It made a low before it tapped into a higher time frame PD array. So what is this? This can be classified as a liquidity inducement. This is inducing buyers, premature buyers, that you have to buy the market here, or this will act as a support. So premature buyers will look at this high and say this will act as a support. So when the market comes here, they have to buy, and they will place their stop loss just below this low here. So their stop loss will be somewhere here and their buy position will be here, and they will be buying prematurely, because as we know that we have to wait for the market to tap into a higher time frame PD array. So this is a liquidity inducement. So the first requirement, higher time frame PD array or buyers. Then the second requirement is you have to have this low swept. This is a liquidity. So below every low we have liquidity. So this liquidity has to be swept. So now we know that the market will come, because the market cannot go up without first entering into this high time frame PD array. So this was an inducement, and it was liquidity because people are going to buy. So we have to wait for the market to tap into this liquidity and tap into the high time frame PD array, or we can say now we can expect a change in the state of delivery, right? So that is your second requirement, a liquidity sweep. What is your third requirement? A third requirement is we must experience a market structure shift. What is a market structure shift? A market structure shift is when the market breaks structure into the opposite direction to where it was initially going. So if you realize that we have this low, we have a high, then we have a lower low. When the market makes a lower low, we expect the market to keep on going, making lower highs and lower lows, lower highs and lower lows. But then a change in market structure shift occurs when this high gets broken down. Now we know that the market is no longer bearish. We are no longer going to experience lower lows and lower highs. Now what's gonna happen is we're going to experience higher highs and higher lows. So the third requirement, you have to experience a market structure shift, which is what we got here. The fourth requirement is, does this market structure shift here, was it accompanied by a displacement candle that consists of fair value gaps in it? In other words, from this low to this high, did we experience an energetic move up? Why do we need to have a displacement? Because a displacement tells us that sell side pressure is dying off, and now we're going to experience buy side pressure. That means we experience a sharp move up in the opposite direction, because the market was going down, now the market is going up. So that becomes our displacement. And third, is our displacement accompanied by a fair value gap? A fair value gap, is when it's a three consecutive candle whereby the first candle's high does not meet or does not overlap with the third candle's low, in the form of a bullish fair value gap. In the form of a bearish fair value gap is the opposite of that. The low of the first candle does not overlap with the high of the third candle. So in this instance, because we're looking for a bullish order block, we're looking for a bullish fair value gap. So the first candle high can be here, and the third candle's low can be here. So is there a space in between where they do not overlap? Where they do not overlap, then that's our fair value gap. Now, in all of this that I've been saying, where is our order block? Our order block mainly form between the leg of this high and the leg of this low, right? So you'll find your order blocks somewhere in between this high, so it can be here. The order block can be here. The order block can be here, and it can overlap with the fair value gap. Why am I not using the candle that are down here? Because for a high probability order block, you need to see down candle that are responsible for this liquidity sweep. So you must use candle that were formed before this low was taken. After this low was taken, it's going to be a low probability order block. So what you do is you wait for the market to retrace into the order block and take your buy position either at the 50% or at the open of the order block, and you hide your stop loss. You target high and you hide your stop loss below a protected low. This is a protected low, just like that. Okay, guys, now that we understand the theory part of the order block, let's go to the chart and look at a few market examples. Okay, guys, for our first example, we're on the Nasdaq 100 on the 1-day time frame, on the daily time frame. So what was the first requirement? The first requirement was we have to have a higher time frame PD array. So we have this higher time frame fair value gap. That becomes our first requirement. The second requirement is we must have a liquidity run. We have this market here making this low, and this low was run here. The market made a high, then the market made a low, then the market made a high, then people prematurely bought here. This is your sell side liquidity. You have to wait for the sell side liquidity to be run. So now sell side liquidity was run, the market tapped into a high time frame EDR in the form of a fair value gap. So now we need to see a change, the market structure shift. I mean, we have to see the market closing above this candle here, which it did up here. So we have this candle high, low. We have this candle low and this candle is high. This is our displacement move, right? Now, the fourth requirement is this displacement accompanied by a fair value gap. Yes, we do have a fair value gap here. We have our fair value gap here. And where is our order block? Our order block will form in between this high and this low. So you look at the series of down candle or a single down candle that is responsible for this liquidity rate here. So we have these candles. These are up candle, down candle. But in the middle, we have this up candle. So we cannot use this one. So we're going to use this one. This becomes our order block. This becomes our order block. So what you do is you take your position, your buy position at the 50 at the open of the order block, target whatever high you're targeting, and hide your stop loss below this protected low. Simple as that, guys. You target whatever. Okay, guys, now let's look at another example but on a lower time frame. So the first example was on the higher time frame, on the daily time frame. Now we are on the 1 minute time frame to see how the fractionalized model of the market moves. So what we have, the first requirement is that we said we have to have a sweep of lows. We have to have sell side liquidity swept, sell side liquidity which was taken. And the second requirement is that the market has to go into a previous PD array, meaning we have to go into a fair value gap or an order block. So we have a previous order block here. We have a previous order block here. It's an order block because it's also responsible for taking out this low. So this makes it a valid order block, right? So two of the requirements are met: sell side liquidity, valid PD array, separate PD array. Okay. So now the third requirement is that we have to have a market structure shift. Where is our structure? Our structure is here. You can say our structure is here. And we have to have the market closing above this high. This becomes our market structure shift. So the fourth requirement is we have to have a displacement, an energetic move up in the opposite direction. So now we have this high and this low. So this becomes our displacement low. This becomes our displacement high. So we have a displacement. You can see the market was very choppy when it was in this price section. Then it dropped into the sell side liquidity that quickly moved into the opposite direction. So this is our displacement move. So the displacement must be accompanied by a fair value gap. So where is our fair value gap? We have the first candle is high and the third candle is low here. So we have a fair value gap here in this scenario here. Now we have to look for premium and discount. Where is our premium and where is our discount? Take out your fib. high, low, and high. So where's our order block? Our order block is this candle here. This is our order block. But if you realize that, you can see that our order block open, it's not. But if you can realize that is our order block open is not in a discounted market, so we cannot buy at this order block because this order block is not in a discounted market, it's in a premium market. So we need to buy when the market is cheap. So what do we do in this instance? We look for our mean threshold, right? So we look for the 50% of the order block. So what do? We take our fib and we plug it here, and this order block, we put it here. So now our order block 50% is here. So now what do? Then you take your position at the 50% of the order block. That means you buy at the 50% of the order block and you hide your stop loss just below this low. And where do you target? You look left, you look for your highs. So this can be your first target. Your first target can be here. And when you get to the first target, what you do is you move your stop loss to break even and you take partials out of the market. So now what's your next target? Your next target will be this high. This high is your next target. So you target this high. You can see how great this risk to reward ratio is. So let's see if the market went to that high. The market hit your stop loss here, but the good thing about this is when you're managing your risk, you have to, if above every high, you must take your partial. So above this high, you took your first partial and you move your stop loss to break even here. So, and above this high again, no, not this high, above this fair value gap here, 50% of this fair value gap here, you take another partial and you move your stop loss just above this low. So your position would have been stopped after this run here, because your stop loss will be here and the market hit this and you took your partials and the market came back and hit your stop loss. Okay guys, if you've enjoyed this video, please comment below what can be improved and how the delivery of this video can be improved. And when you're at it, please like, subscribe, and comment to this video. See you in the next video. Peace out.